All right, everyone. Welcome back to another episode of Masari's Unqualified Opinions. I'm Ryan Selkis at 2-Bit Idiot with another edition from the Citadel. I've got another guest who's in a Citadel of his own, Chad Cascarilla, who's the co-founder and CEO of Paxos. Chad and I have known each other for a long time because he's been around in Bitcoin almost from day one. I'd say you are so early in the Bitcoin ecosystem. You could make an argument that you are connected to Satoshi or at least have a probabilistic chance of being Satoshi. I'm exaggerating only slightly. But before Paxos and ItBits, Chad was also a prolific investor both in the Bitcoin ecosystem and during the subprime financial crisis in 2007, 2008 via Liberty City Ventures. So we're going to talk about the origin story. It is so fortuitous that we had a reschedule on this particular recording because just a few hours ago, we had more unprecedented Fed action where they are now going to purchase junk bonds. The money printer will not stop going burr for any reason, it seems. And I'm not sure that there's any insight. Today was a big day with unemployment claims, now 17 million unemployed in 3 weeks. The word that I keep saying over and over again right now is unprecedented. It feels like in every single interview. Let's start by talking about the parallel universe of 2007, 2008, which is a scenario and a financial crisis in and of itself that you were intimately knowledgeable of and investing around. So maybe the quick backstory before 2007, and then we can talk about what ultimately got you into Bitcoin was, which was the financial crisis itself in 2008.
Yeah. By the way, great to be on, Ryan. I appreciate you having me here. I think it definitely is timely. And I've seen versions of this before. I've spent my career as an investor and investing in financial services companies globally. And so this is my kind of third big bear market that I've lived through, 2000, 2008, and now today. And at least bear markets in the stock market. I've lived through a few more of those in the Bitcoin world too. But I think, there's a lot of parallels between today and 2008, and there's a lot of things that aren't the same. But it is a useful framework. I started my career investing in financial services companies. I started an asset manager in 2005 with my co-founder, Emil Woods. And that really started investing globally in stock markets, and then began to add private equity vehicles and our venture capital arm, Liberty City Ventures. And it allowed us to really look at the entire life cycle of financial services companies. And we did a really good job of capturing a number of important trends. The first was this big trend in terms of changing how markets worked. It used to be based on the floor, trading in like eighths and sixteenths. For some people, might not even realize that anymore. And now you're trading in microseconds. And
now the only time you hear teenth is if it's in a drug deal.
I wouldn't know anything about that. So I don't use my Bitcoin for that. Only my Monero. So anyways, we started to invest, taking advantage of that theme, creating private equity vehicles, investing globally in exchanges and clearing corps. And as we came into the 2008 financial crisis, we really recognized things were totally out of whack in the lending markets, and the apex of that kind of wildness was the subprime market. And we were short subprime, then going into the crisis in some sophisticated ways through CDS and also through some other instruments. And this allowed us to really take advantage of the crisis. And we actually then created a private equity fund that bought distressed mortgages coming out of it. And what became really clear as we went through that crisis was how broken the plumbing of the financial system was, how it significantly exacerbated the crisis. Didn't cause the crisis. The crisis was caused by too much debt. And, perhaps even more broadly, by really the nature of fiat money. But that wasn't, and what was really surprising to us, that wasn't the only reason it kept kind of spiraling, not just too much debt. It was that the plumbing itself wasn't working. And you couldn't trust counterparties as the crisis began to unfold because you didn't know if they were going to be good for the loans that you were extending to them, or even the settlements of transactions, because almost nothing settles in real time. everything is settling over a day, 2 days, in some cases weeks or months, in the case of like syndicated loans or a house. And so that creates a lot of counterparty risk, and people just became too afraid, and things began to grind to a halt. And there really is no reason to have settlement risk at this time. You have modern technology. You can order toilet paper on your phone. It can get delivered in the same day. Why are we taking days to settle electronic piece of information that is a trade? I don't think there's a good reason for it. But if you fast forward to today, believe it or not, the infrastructure is really no different. There's more regulation. There's more capital. The banks are, in general, safer. But at the end of the day, and by the way, not just the banks, the brokers and other pieces, important pieces of the financial system are safer. But the actual plumbing is still no different. It's still COBOL mainframes from the 70s, and they're really a real lack of responsiveness. And just like in 2008, where the crisis was caused by subprime and too much lending, today the crisis is caused by a pandemic, one that no one could really have predicted. But it's being exacerbated again by the fact that the plumbing is causing everything to lock up. And that has forced the Fed, in part, this has enforced the Fed to come in and really supply a huge amount of liquidity, more than anyone's ever seen. And just like you said, the word is unprecedented. I think that's the exact right word to use. There are certain examples that you could use. We got to go back really far in time, and it gets really murky. You know, like I've seen examples of comparing this to the outbreak of World War I, which was unexpected, and everything was globalized. There have been other pandemics like the Spanish flu or whatever it might be. But this is kind of really amazing that today there was another 6.5 million unemployment claims. That makes, as you said, about 17 million since the crisis started.
Which think is there's probably understated, by the way, because they
because they can't process
them. Yeah. And they already revised last week's upwards by a few 100,000 as well. So.
Yeah. No, I think, before we're all said and done, and by the way, you started with a 3.5% unemployment rate. So if you add in the claims plus a 3.5% unemployment rate and what's likely to happen over the next couple of weeks, you're talking about an unemployment rate over 20%. I mean, that starts to really get unprecedented, and especially in such a short period of time. And so that's led to unprecedented reactions, which is a huge amount of liquidity being poured in, a huge amount of stimulus programs being poured in. And, there's a lot to digest about whether or not it's too much, too little, just the right amount, which we can absolutely talk about. But I think going through the crisis in 2008 is what really got me interested in Bitcoin and blockchain, because seeing how the system didn't work by having all these centralized intermediaries, but instead realizing there could be a different way, one based on blockchain, where you could have more decentralization, you could have more access, and because of that, you actually have something that's more resilient and more fair, and that allows more innovation. That really excited me. That's what got us to start Paxos. So when we came across Bitcoin, it was 2010. You're right. It was very early days. It was just like 3 cents. So very early we got involved and we were mining it, but immediately thought about how could we apply this to these problems that we know in financial services that are so crucial to be solved. And it's a long process to get to where we're at today with Paxos, but I think we finally getting to the point where the fundamental changes that we believe should happen is something that everyone else is beginning to understand and believe and starting to implement. And I think that's really exciting, and we can talk about that a little bit more too.
Sure. I mean, there's a bunch of different rabbit holes that we can go down. One thing that I'm curious to pick your brain on, to my knowledge, you might be the earliest mainstream investor, I guess, might be one way to think about it, of anyone that I know, in terms of when you started to accumulate and when you took this seriously. And the comparison I'll make, I won't, kind of try to pretend that I know exactly when other people made their first purchases. But for me, I first learned about Bitcoin and became acclimated to it and actually considered buying it in mid 2011. This was around the debt sequester and the U.S. Debt downgrade by S&P. And at the time, there was basically 3 ways to trade that event from a macro standpoint. You could buy gold. If you thought this was going to destroy the dollar, you could short the U.S. Treasury ETFs, or you could buy Bitcoin. And I think I'm one of the few investors that took that thesis insanely seriously and still went 0 for 3 in the execution, because I ended up shorting the Treasury ETF, buying gold, which basically did nothing. The Treasury ETF rallied because everybody, went to a flight to safety, ironically, and then I ignored Bitcoin because it was hard. The thesis made sense behind Bitcoin, but how did you get enough conviction that you started taking it very, very seriously, and mining it and accumulating it back in 2010 when it was so low? How did you think about the optionality? Because from an outsider's perspective, because it was so cheap, it was almost expensive for you to spend so much time thinking about it and setting up the apparatus and thinking about the infrastructure, which I think requires a level of vision that 99% of today's crypto investors did not have, either because they weren't acclimated to it early, they weren't familiar with it, or they were like me and they were either a combination of too lazy or, thought that this was not going to get to the critical mass. What was different about this for you? And was this just a portfolio allocation strategy? Because from an outsider's perspective, it does look like you went all in much, much earlier than the typical person, especially since you were not a hobbyist, right? You were a professional investor already and had some success with Liberty City Ventures.
Yeah, with Cedar Hill and our other vehicles,
Mm-hmm.
I think what really captured our imagination was the idea that this could be the ledger of record for assets
Mm-hmm.
in a decentralized way. And we, having understood the financial system, the restricted databases, which are essentially how it works now, you either have to be a member of the Federal Reserve, you have to be a member of DTC to access where assets and cash sit. You have to be a member bank in order to be able to issue onto the Visa network. So
Mm-hmm.
we saw how there was huge amounts of value that accrued to private networks and to intermediaries that alone could access databases. And we also saw how that exacerbated the crisis. And so when we came across
Mm-hmm.
Bitcoin, I can't tell you that I thought it would be where it is today, 7,300 and as high as 18,000. I can't say that I knew that for sure. In fact, I thought that most likely wouldn't happen,
Mm-hmm.
because the rule of thumb is a penny stock usually goes to zero. Maybe it goes to $10. And I think that was in some ways the framework we used. But we looked at it as this could be a really interesting call option because of the technology. Forget the price for a second. This technology was really new and innovative. And we're always looking for new technologies as dedicated financial services investors, especially ones that could be so, I think, fundamentally disruptive. And
How did how
so
did
go
how
ahead.
did you get conviction around the tech elements? Because a lot of people in hindsight will say, well, that this very vibrant ecosystem, there was all these open source contributors, there were all these cryptographers who had captured their imagination. But when you got involved, that was not true, right?
No,
Adam Back is
no,
on record saying this is not going to work, right? This is a
yeah,
foolish idea. Here are all the reasons. Greg Maxwell, same thing, right? You were earlier than some of the people that should have known better in theory.
yeah.
Um, what about the tech and the diligence there? Again, not because you're talking about small, 3 cents, right? Like even if you bought, like the whole money supply for someone that was a
A
traditional
couple $1
investor,
million.
yeah,
Yeah.
right. It's still small potatoes for someone that's managing institutional capital. But the time commitment to figure out the tech, given that there were a lot of other smart technologists, many of whom created the precursors to Bitcoin, or are now the lead maintainers and kind of core developers, dismissed it early. Um, did that factor in at all, or kind of how did you get to know the tech was so robust, and how did you start triangulating on this as something that could catch fire, not just as a reserve asset and a settlement layer, but a functioning open source project that wouldn't just kind of die on the vine because it didn't have any known developers working on it?
Well, I would love to tell you that I knew that that's what was going to happen. And I'd love to tell you that I even have the capabilities to know that that could have happened. But I don't. I'm not a cryptographer.
Mhm.
I'm not a traditional technologist. And so I didn't actually have the tool set to define that. But what I did have is a framework with which to think about it.
Mhm.
And, constantly dealing with assets that could have asymmetric payoffs, and constantly dealing with creating portfolios of these assets
Mhm.
made it not a dependency that it had to succeed in order for me to buy it. Right? It's not like I put all my life savings into it, so you got to be 100% sure, right? And so I spent a lot of time on it, but I'm spending a lot of time looking at a lot of new technologies, and so that is my job. As a financial services investor and an early stage investor in financial technology companies, that is your job. That's what you're supposed to do. And clearly, if the threshold was you have to have 100% conviction that this will work, you're going to miss a lot of things at the early stages because you can't have that.
What were some of the other things that you and Emil were looking at in the tech space or financial services space at that time, and what percentage of your bandwidth did this experiment take up, since it was a small position?
Well, I think there's a couple components to that. So, you have a portfolio, you're investing across a wide range of things. So, and this is 2010, we own distressed mortgages. You're just, barely a year out of the crisis. You own distressed mortgages. There's alternative lending platforms that are just beginning to become developed, both P2P and B2B, a whole variety of different ways of intermediating what's going on. There was new financial technology that was coming around that was fixing process problems. And so I think there's lots of exciting things that were happening, but none of them were fundamentally changing the system. Right? Some of them might be putting better UIs on the current system and a better experience, but that's not the same thing as fundamentally changing the architecture. And that's what we thought blockchain could do. Now, remember, in 2010, Bitcoin and blockchain were the same thing. I mean, they were synonymous. There was no range of things. There was no Algorand or Stellar or whatever it was. Ripple hadn't come along, nor Ethereum. So nothing else existed. So if you wanted to be interested in what was going on in the blockchain world, you had to be interested in the Bitcoin world. And so you got involved, you understood what was happening. And over time, we began to realize what I think everyone else realized, that blockchain and Bitcoin are not the same thing. Bitcoin is a specific example of blockchain. And it's a very good one, but it's not the only one. And so that meant that as the ecosystem began to expand, there was even more to do. And it was therefore more valuable to spend time on it. In fact, my co-founder at Cedar Hill and Liberty City, Emil Woods, has a blockchain fund. I'm not actively involved in it because I'm spending all my time on Paxos, but he just has a fund dedicated to crypto and blockchain investments. And he's not the only one. There's so many of them now. But you couldn't have done that in 2010. You had one option. Either you thought blockchain was interesting and you bought Bitcoin, or you didn't think it was interesting and you went and did something else for a couple of years.
Yeah, there was no blockchain, not Bitcoin, until post Mt. Gox.
Until Ethereum, really. Right? I mean, that was the first example of it.
Yeah, I mean, you started to see like Mastercoin and colored coins and some of these other elements. And
I almost forgot about.
I just saw it. Yeah, they saw it spike, and then all of a sudden you heard, okay, how Bitcoin's not interesting, but this thing, the blockchain, really is, because it could help with settlement and all this thing. And maybe that was because of the conversations that you and some of the other more traditional Wall Street types were having, where they put two and two together and they said, clearly there's something interesting here, but I just don't want to get involved with this kind of weird, digital asset. But you're right. I think.
And by the way, that was so common. That was so common then. And by the way, it's still common now. But I mean, then it was so common, which is, I don't get Bitcoin. You can't put through too many transactions per second. There's a lot of slow latency. This is not really money to be used. How it's never going to compare with Visa, MasterCard. And so nice try. Let's go on to the next thing, and let's see how else we can use blockchain. It's all going to be about private blockchains. And there was a huge period of time where it was all going to be about private blockchains, kind of like it was going to be all about intranets back in the day, not the internet. Even when Bill Gates wrote his book, and then he had to go back and change it before it was released because it was obvious it was going to be the internet, not intranets. I think it's the same thing with public versus private blockchains.
Yep. So let's talk about the transition from investor to operator, because obviously, to a certain extent, if you're a professional investor, you are operating a fund, right? In your case, multiple different vehicles, but you invest in ItBit in 2012, give or take, somewhere in there, 2012, 2013.
Yeah, that's right.
Yep. And then when did you buy it out, and how did you manage that transition from Liberty City ventures and the investment vehicles to taking on the CEO role?
Well, so there was really actually no buyout. What happened is we incubated ItBit within Liberty City Ventures.
Okay.
And we've incubated a number of different businesses, whether in Liberty City Ventures or otherwise.
Mm-hmm.
And normally, we incubate them, they grow up and they kind of move off, or maybe they don't grow up, they don't succeed. But in the case of ItBit, when we started to grow it, one of the co-founders who worked with me at Cedar Hill and with Emil at Cedar Hill was Rich Teo. And he's still one of the co-founders. He's the CEO of Asia. He's been living in Asia now for the last, I guess, 10 years or so. And anyways, he's worked for us since 2005. He started really running the company. And as we got close to being able to get a New York State trust, which I think was the pivotal moment for ItBit and Paxos, because it is the piece of regulatory approval that allows us to not just operate in the U.S. as a crypto exchange, but more importantly, it allows us to operate as a custodian, holding people's assets and being able to put them on a blockchain. And so when it became clear that we could get this trust, and it took us almost 3 years, I actually made the choice that I would rather spend my time building ItBit and Paxos than continuing to be an investor. And it's not that I don't like investing or love investing, because I do. And it's not that I don't think I'm a good investor, because I do think I am. But sometimes you want new challenges. And I had never built an operating business. I built an operating asset manager, but not an operating business in the way that ItBit and Paxos is. And it's been, a real both great challenge and learning experience for me over the last 6 years. And so that's why I came in full time to run it. And so that was really me coming in at an executive level. But the company's been funded by Liberty City Ventures, by myself, by outside investors, including RRE and Canaan, amongst others. And so we have a number of people who funded it. So it looks just like any normal venture-backed business, so to speak. It's just that when it started, it was really incubated inside Liberty City.
Got it. And let's talk about the different lines then at Paxos, because at first it was just ItBit. Once you got the trust company charter, explain to people why that matters. And I believe you're the first to get that over the goal line. There's subsequently been a couple of others that have done the same, but the first New York trust charter and what that allows you to do that's unique in the U.S. exchange space, at least.
Yeah, I think, in fact, we were the first one to get the trust, and it actually predates the creation of the BIT license. So you can see we really spent a lot of time, and the DFS was great about being forward thinking around how they could use the current regulatory structures to be forward thinking and enable new businesses to come in. Now, I know there's like pluses and minuses around the BIT license, and we could go into all of those other areas, but really this trust predates it. And so we have all of the authorities to act like a BIT license holder, but we're a trust company. And a trust company is basically a bank, but it's actually a bank that's safer because we don't take deposits and then go make loans with the deposits. Nobody's giving their assets to us as a loan. What is going on is our customers are giving us assets and we're holding them fully segregated, completely separate in their name. If anything happens to Paxos, your assets are still safe and good to go. And so a trust company is actually a really safer version of a bank. That's important for the role we want to provide and play, which is being a financial market infrastructure. And the whole point of financial market infrastructure is not that you're giving your assets to somebody who you trust and then they're going to go do something with it. It's that you're giving your assets to them and you know they're always going to be there. And historically, in the US, financial market infrastructure is set up as trust companies. DTC, which holds all of the stocks and corporate bonds in the US, is a New York State trust. Bank of New York, the largest custodian in the world, New York State trust. The CDS clearinghouse, New York State trust. So this is a really time-worn path. And we want to think of ourselves as so much more than an exchange. That's where the branding of Paxos has come from, because the whole point is how can we take the world's assets and put them into a blockchain environment? How can we upgrade the way assets move to allow them to have the benefits of being on a blockchain, even if they're not necessarily something that's natively digital? And so there's $600 trillion of assets in the world. My strong belief is that in the limit, in a long enough time horizon, all of those assets are going to end up on a blockchain. Now, that could take 20 years, but that doesn't mean that it's not going to happen. And our goal is, and getting the trust, was to really be a provider of infrastructure to enable that to happen. And so that's why we went and got it. It's really a big differentiator. There are a couple other New York State trusts out there that have subsequently been chartered, but they're really not being used to create financial market infrastructure so much as they're being used to play the role of a custodian in crypto, or maybe to play the role of an exchange in crypto. That is one very important piece of our strategy, but it's much more than that.
Mm-hmm. So let's talk about these multiple components, because structurally speaking, financial services are typically less technology companies and more regulatory companies. Crypto offers this unique hybrid approach, I'd say. Even though Jamie Dimon will, every single year he gets up and he says, "Oh, we're a technology company first. Look at how many developers we have." Everybody knows that's not true. Anyway, for crypto, it's probably more of a clean hybrid, at least for the regulated businesses. Some of the more loosely regulated businesses, or the ones that are playing a little bit fast and loose with jurisdiction, with KYC, are certainly more technology, fintech businesses. For you guys, where are you spending the lion's share of your time? Because it is going to be impossible for a company that's as regulated as Paxos and ItBit to compete on liquidity of certain trading pairs that are outside of the top, several assets that are listed. And it's going to be impossible for you, justifiably so, to offer 100x leverage products, right?
Yeah.
So it seems to me, and correct me if I'm wrong, that you've basically, more or less triangulated on three things. We're going to focus on the top, 3 to 5 assets, and provide liquid trading pairs for institutional customers that have certain requirements for which venues they actually conduct their trading on. You've got the stablecoin, and then you've got this new Pax Gold, all of which are playing into the same, I'd say, single macro thesis that Bitcoin is going to be a big asset, therefore crypto will be a large asset class. And as that scales, maybe we will scale our asset support over time. Is that the right way to think about your mental model for how this is going to evolve? Or how do you think about the positioning of the business and how much you're doing technically versus from a regulatory perspective, given that this approach has been very intentional to work to build trust with the regulators in the state of New York, which is about as cumbersome as you could possibly imagine?
Yeah, so a couple of things off of that. I do agree, by the way, that we're trying to not be a financial services company. We're trying to be a technology product company that's enabling other financial services firms. And that is a big difference. And it doesn't matter how many engineers you have. You could have 100% of your company be engineers. It has to be about the way you're trying to solve problems. And a lot of the way you can tell about how someone's trying to solve problems is how they organize themselves. So if your engineers are reporting to your chief administrative officer, which happens at a number of banks, that's probably a good sign that you're not a technology company. Whereas if your product and engineers are a majority of your company, and they're the ones that are helping to drive the roadmap, if not the prime movers of that roadmap, then you look much more like a technology product firm, a financial product firm, as opposed to a financial services firm. So I think that's an important point to make. And the reason why it's so relevant is because I think it's very difficult to make that organizational shift, that mindset shift. That's why it's so difficult for, I think, incumbents in financial services to begin to react to this new world. Because you're solving problems in a different way, you're creating products, you're interacting with your customers in a different way, and that's a fundamental shift. And it's not a fundamental shift that's easy to do when you have tens of thousands or hundreds of thousands of employees. In fact, it's probably impossible to do. But it doesn't mean that some of the incumbents won't survive and potentially still be some of the largest players. But that's really because of the weight of history, as opposed to what I think can happen is a lot of disruption, like you saw with Netflix, or you've seen in energy markets, or you've seen it in the media markets. You saw Google do it to advertising, amongst other things. There's so much opportunity to really fundamentally shift financial services because of that, because that services problem is not the way you should be solving problems now. Now, so if you think about what we're trying to do at Paxos, is we're really trying to be this financial infrastructure that anybody can build products on for this new world. So we've built our own products in certain examples, but ultimately we want anyone to use our regulatory stack and our APIs to build on top of it. So we built our own stablecoin, but now we have one for Binance, we have one for Hopi. There's a bunch more that we'll be announcing over time. So the whole point being, anyone can use our infrastructure to create tokenized dollars. We've created our own gold token, but we're completely fine. We'd love other people to create other tokenized commodity products on our infrastructure. It's, that's the idea here. We're a custodian holding all these different types of assets. We're holding cash, we hold gold, we also hold crypto. In the case of crypto, we created an exchange because our custodian role meant that we had to not take counterparty risk. You can't go route trades to other exchanges that aren't following the right rules, that are offering 100x leverage, that are offering coins that are really securities. And so that necessitated us to always have IPIT as a liquidity pool. But if you look at what the underlying factor is, that's a product using our custody capabilities. Our tokenization is a product that's using our tokenization capabilities, all because we're a custodian. And we're now doing that in securities too, where we're tokenizing securities. And we have firms that are moving and trading real live US equities trades now off our infrastructure. We want anyone to be able to build off of our APIs to create trading opportunities and brokering opportunities for their clients using what we've done. And so that's where I would kind of frame what our grand strategy is here. How do we act as a layer that anyone can build on? It shouldn't just be one type of wallet that's Paxos's wallet. It could be PayPal wallet. It could be a Libra wallet. It could be a Google wallet. It could be an Apple wallet. And that's completely fine. We're not here to pick winners. We're here to provide capabilities to others to build on top of.
I think that's a great strategy, vision. It certainly makes sense. It's a little bit different from the question of where is the business today, right? And so, we've heard about securities tokenization since 2013, right? This was the original blockchain, not Bitcoin use case. And it seems that maybe that is slowly starting to get solved. And yes, there are some experiments that are going on. But it is fair to say that the three core pillars of the business, at least today, continue to be the gold product, the stablecoin, and the IPIT exchange, correct? Or have some of these tokenized security experiments taken off and gotten critical mass so that you are seeing more third-party institutions plug in and try to build these structured products?
Yeah, I mean, look, I don't think there's any doubt that what needs to happen in securities markets takes time. It takes years. We're doing it. We have a no action letter from the SEC, which is fairly rare. We're working on having a clearing agency registration. That'll probably happen early next year. That's when we'll be able to go live. Until then, a lot of what we're doing is in early stages as opposed to live products. So there's no doubt about that. Now, having said that, these are real live equity trades that are settling through. It's just we're limited to a certain small pool of securities. Really, that's because we know securities is the biggest pool of assets. There's $600 trillion of assets in the world. It's something like 150 trillion are liquid securities. Getting those onto a blockchain takes time. Once you've done it, it's really powerful. Where are the areas where you have early adoption are areas where you don't have that level of regulation. Guess where you don't have those levels of regulation? You can tokenize cash, not really that regulated. We're regulated. We create a regulated token out of it, but cash tokenization is not per se regulated. There's lots of examples of non-regulated institutions, like say True USD or whatever, who've tokenized cash. Even USDC, it's not a tokenized dollar. It's issued by Center, which is unregulated. And so you can do that in cash. Gold, we have a regulated gold token, but you don't need to be regulated to create a gold token. Tether did, and we know they're not regulated. And you can create an exchange that's not regulated too. So, but the point really being that where's the early adoption is where there's lighter regulation so you can get the products out there. I don't think that it all changes our viewpoint about where securities is going to go. People have different views. I really strongly believe that's probably the most important thing that we can do. But the key point is, it's not about the exchange. It's not even necessarily about the products that we've created. It's about the capability that we put into place, which is a custodial infrastructure to handle any type of asset.
Mm-hmm.
And then you have to get firms to be able to use that capability. And so we've done that with dollars. So Binance created their dollar stablecoin off of what we did. Huobi created their dollar stablecoin off of what we did. We've created a dollar stablecoin off of it. There's going to be a number of more examples of that. And so that's a prime example of, we're creating a capability that anybody can leverage and use. And I actually think we'll have examples of people doing that off of exchange infrastructure too. We won't be the only exchange using our infrastructure. We actually have a number of things coming down the pipe where other people will be using our infrastructure for their exchange too. And so that's where I'm trying to say is like, it's less about exactly where we're at now, and it's more about how this continues to evolve into an infrastructural use. It's very difficult, like say Amazon with AWS. The first customer of AWS was Amazon. Now it's not, and it still might be the largest one, but it's not the only one. And so we had to build our own products that were sitting on our infrastructure, but we've now moved to the point where that's not the case anymore. We have examples where it's not the case.
Why can't you trade Pax Gold on ItBit today?
You can. You can trade it. So Pax Gold trades against USD. You go to Paxos.com if you want to buy large sizes. You can buy right from the London gold market. If you want to trade the tokenized gold, you can go to ItBit and trade it. But by the way, it's been listed on a lot of other places as well. FTX has both a future off of it and the spot trading. Kraken has a spot trading. Bithumb. There's a lot of other exchanges that'll be listing it. We want it to be listed as many places as possible. And if someone came along and said, we'd like to create our own gold stablecoin, we'd absolutely do that for them.
Got it.
And we've had conversations around it.
Okay. Yeah, I'm curious. So both our feed, Nomics, and CoinMarketCap are not picking up that trading pair, which is what I had searched for earlier on. But maybe that's just something that's overlooked with the data company. So we'll have to look at that again. So there's another element here with adoption where the digital gold pairing and narrative seems like it's accelerating, getting more compelling by the day. Has that impacted your short-term thinking on kind of going all in on securities tokens and playing this long game versus take the money that's kind of dangled right in front of your face? And it strikes me that Paxos and ItBit seem to be maybe the most ideally positioned company from an institutional narrative standpoint to be able to say you can do all of your gold trading and all of your Bitcoin trading, digital gold trading in one platform, and we are regulated and we have all these checks and we'll be able to get through your compliance process so that when the Fed prints another $10 trillion and we have stimulus number 4, 5, 6, 7, your purchasing power isn't getting destroyed. And if you don't like Bitcoin, that's fine. 5% in Bitcoin, 95% in Pax Gold or something to that effect. From a narrative cycle standpoint, it seems like position A. I'm curious if that conversation has actually gained any traction right now, because the pairing seems powerful. If you're just trying to do the whole song and dance about why Bitcoin is the savior and it's going to be a true international reserve currency and digital gold inflation hedge, that's one thing. But to be able to say, look, this is the play, here are the available assets, and put both of them side by side, I have to feel like that could be making some headway. We haven't really heard that from other institutional managers just yet, but I wonder if it's because they're missing half of the equation.
Well, I think there's a couple things to unpack there. The first is, my view, the exciting thing about Bitcoin is that it could become digital gold, but not that it is digital gold yet. There's a lot of things that it has to go through. It still needs more tests. It still needs more adoption. It still needs more stability because it has hit a point of widespread use. And so that hasn't happened yet. That doesn't mean that Bitcoin isn't a good investment. I think that actually makes it a very good investment, because it can have significant outperformance as you go through that adoption curve. Whereas gold is obviously something that's been a monetary asset for now thousands and thousands of years. People understand what it is, but surprisingly, it's not easy to get gold into your portfolio. And when I mean by gold, I mean real gold. You either own it physically or you own synthetic gold. And what I'm so excited about with Pax Gold is that you have the opportunity to own real gold in a digital form. Each token relates to the serial number of a bar in a Brinks account in London. And so you actually own allocated gold, you have legal title, you can transfer it around to anybody else in the world. And you're buying this in a way that's fully segregated in your name. That's very powerful. It allows retail investors or frankly institutions to now own London gold where you couldn't before. You could own a gold ETF, you could own the gold futures, and we've seen lots of problems with those instruments as we've gone through this period of turmoil here. And if you want to go buy physical gold in your retail person, you're paying a 20 or 30% markup today. That's not always the case. Generally, it's like 5 to 8% or 10%, but that's a huge markup still. And now you could go and now own real gold that can be fungibly moved around in any fraction, 24 hours, 7 days a week, nearly instantaneously. And so I think that's a really big improvement. And so I think given the turmoil we're in, there's a place in people's portfolios for both assets. You have to put the weight on which one you want to own based on your risk tolerance and your view of the world and the work that you've done. But I think we've created a way for you to have Bitcoin, a way for you to own gold, and frankly, a way for you to own dollars that has the least amount of risk and the highest level of underlying ownership. And so even with our dollars, they're backed by T-bills or FDIC insurance. So you're never taking risk against a bank. When you own Pax dollars or you own Binance or you own Hopi, you are actually a Hopi dollar. All of those are T-bills. So you're bankruptcy proof against any generalized or even specific bank failure. That's really powerful. And it's making money be just as safe for individuals as it is for the banks. Because what do banks basically have? They have dollars at the Federal Reserve that's backed by, well, theoretically, it was just T-bills. Now it's all kinds of different stuff. But anyways, it was just T-bills. And if you basically have a dollar from Paxos, it's backed by T-bills. It's just as good as central bank money. That's better than what you can get from a bank. And so we've created these ways to allow you to own assets that you couldn't historically do, yet still have the same utility, if not more, as traditional assets.
Mm-hmm. Makes sense. So, I recognize that the much bigger multi-trillion dollar, maybe even, larger than that opportunity, tens of trillions, is in the security side. Some of the early experiments we've seen have been in markets where they're inefficient, there are information asymmetries, and there's significantly less liquidity than in equities. And in particular, you've seen a lot of experiments around real estate. What do you think the first credible wave of non-gold securities will be that are tokenized and issued on chain?
Well, there's been some early examples of doing some commercial paper with certain institutions. I think it was Mercedes, I think, that may have done an issuance. We've seen some other kind of one-time issuances happen. I know T0 has been trying hard. I think we took a slightly different approach. And because we got the regulatory approval of the trust company, and we've gotten follow-on regulatory approvals from the SEC, we have a full DTC participant account. We have access to the Federal Reserve National Settlement System, full access to SWIFT. We've built an entire regulatory stack sitting on top of our trust. And in the case of securities, the no action letter and the full DTC participant account means that we're backward compatible with the way the world works today. And that's really important because in order to go from where we are now, which is essentially zero assets on the blockchain, aside from native crypto, essentially zero to this 600 trillion, you have to figure out a way to do a migration. Mm-hmm. Now, I'm not saying that you won't have new uses that just immediately pop up for securities that can go around an entirely different route, not involving the current incumbents. That's definitely possible. But for things like U.S. equities, you need to figure out a path of adoption that allows the market to migrate, because there's a network that already exists. That network is working a certain way. How are you going to get it to work a different way? That's what's been so hard for all these firms to do, because blockchain is a network, and the network effect works against you before it's working for you. It only works for you when you get to critical size. And I think we've taken a different tact here, which is you can operate on Paxos with zero change in what type of integrations you need to do, because we've simplified it and made it backward compatible. And that's, I think, what we've done that's different than others. It was not an easy path. We've been working at it now for 4 years. We're finally live with Credit Suisse and Instinet and Nomura. SocGen will be integrated hopefully within the next several months, a month or two. And we actually have a number of other participants that have already verbally agreed to join. So you'll see this gain critical mass. And when we get the CA1 approval from the SEC next year, we'll be able to really turn this on. And it'll start with equities, but it's going to be about so much more than that. And that's what's exciting, I think, is how you can take these markets with this old infrastructure that are clearly not fit for purpose anymore and get a real fundamental change. And I think that's why it hasn't happened yet, because you just can't flip that network over without all of this other foundation that gets laid. And historically, venture-backed firms can't have that much runway to be able to lay the foundation to get to this point. It's just not how they generally operate. It's let's get an early product out there, let's show traction, let's show that it works, and let's pour gasoline on the fire because it's already lit. As opposed to, I got to go spend 4 years building an infrastructure in order to prove that I could build a product that would work. I mean, generally, that makes sense why you wouldn't be a venture-backed firm in that type of business, because it is a long tail.
Yeah, and it's crazy, because you can make the argument that the seigniorage model for Bitcoin and other digital assets is the only reason that the industry has made it this far and is still around, because you do have that long-term speculative sidecar investment to venture capital investing, right? And this happened especially in the early days. You know well. I mean, from my time at TCG, it was the same thing. There were certain investments that you made not because you thought they were going to outperform Bitcoin, but because if you didn't make them, then Bitcoin wouldn't have the infrastructure that it needed to get to the next level. So there are these kind of full Ouroboros investments that most people don't appreciate, especially in the earlier days. Now it's probably a little bit different, because there's still a ton of upside for Bitcoin, but it's harder to 1,000x from here. It's easier to 1,000x with from another startup's perspective. That wasn't true for a long time, and in fact, there's only a couple of businesses that have outperformed Bitcoin from a venture return standpoint over the same time period. You would have backed that venture business.
That's exactly right.
Binance and Coinbase, probably being two of them, and then the other exchanges, maybe you guys should include it, being maybe on par with that investment return. I know we've only got a couple minutes left here, so I want to talk about today's developments. And the investor and everybody that is invested professionally dies hard. How do you think about day-to-day trading and just making sense of this market right now? Because we're living in the upside down. 17 million jobless claims. That's probably a few million underweight when you count furloughed employees. And we talked about this in the onset. It could get up to 30, 40 million people unemployed in the U.S., 20% plus, numbers not seen since 80 years ago. And they're not actually fixing many of the structural problems with the economy right now, and kind of what happens next. So it seems like the worst of all possible worlds. Yes, maybe it's a good thing for Bitcoin, but there's a lot of other investable universe out there. Are you thinking about it at all? Or are you just trying to say, blinders on, I'm going to put some of my portfolio on autopilot, or are you shopping around or positioning for worse scenarios still?
Well, there's a couple ways to think about this, I think. The first is, you never can stop thinking about the markets, because even if you're not investing in them directly, and even if they're not giving you clear price signals, because there's kind of a lot of different actors like the Fed now involved in the markets, they're still like telling you a lot of information.
Hmm.
And you need to like take that information and think about it. And so in the case of, the S&Ps fall 30 some percent from the highs, and the world locks up because of the pandemic, and you can't price in the risk, you really have to start thinking about what is that implying. And there's a lot of systemic risk that it's implying. So just from Paxos, even if I don't do anything personally, I think about how do we make sure we don't have cash that's exposed to the banks above the FDIC limit. How do I make sure that we have, maximum level of safety against counterparties? And you have a number of them. How do you make sure that you're really protecting the business so that you're truly safe on an operating basis? Client funds are always safe, but how do you make sure that you're able to weather what could be, just an unbelievably catastrophic storm? And I don't think we're through it yet. I think we've had a big rally. The Fed and the government has thrown a lot of stimulus, but that's not the same thing as saying you're through the storm. And markets are trying to figure out how to discount these activities. But in some cases, they can't discount it because you have the Fed sitting there buying so much assets, you don't really know what the right price is. And so I think the Fed has probably done a good job of relieving the liquidity concerns in the market. Oh, there's not enough liquidity. Someone's going to freeze because there's not enough liquidity. But what is not clear that's happened is, have we alleviated the solvency concerns?
Mm-hmm.
Meaning, is the size of the hole so big that firms fail? And we've seen examples and estimates of maybe it's a 4 trillion size hole, maybe it's a 7 trillion size hole. We don't really know. It's just unknowable at the moment because we don't know how long this is going to go on for. But if it's a big size hole like that, you're going to have insolvencies. The banking system only has $2 trillion of capital in it. And they're not the only lender in the economy, but they're the main intermediators of the economy. And if you have $7 trillion hole, I can promise you some banks are going to fail. You can't have 20+% unemployment and GDP numbers that are being estimated at -30, -40, maybe, and someone, Fed Governor Bullard, said -50. You can't have that type of GDP even for one quarter without a lot of insolvencies. And even though the government is throwing a lot of money at it to try and fill the hole, it's not getting there in time. So I think you have to be thinking about this. So what am I doing personally? Well, the first thing is you can get lost following the markets on a day-to-day basis. And I'm really spending all my time running Paxos. So I make sure that Paxos is safe. The next thing I do is I make sure that I can have a portfolio that doesn't require me to have to manage it on a minute-to-minute basis. And frankly, that means a lot of cash that's in T-bills, just like Pax dollars or Binance dollars or Hopi dollars. Have it either in T-bills or something similar, which is like the product we've created for our stable coins. Mm-hmm. Own gold, but make sure you own physical gold. An ETF or a future is not the same thing. Everyone should think of their own risk parameters, but I don't think it's as good as owning either Pax gold or owning physical gold that you hold yourself. And then lastly, I think crypto. I think, the crisis is proving out the value proposition of, for instance, Bitcoin. The networks, whether it's Bitcoin or Ethereum, are certainly under strain, but they're actually handling this way better than the current financial system. It doesn't mean that though Ethereum or Bitcoin, by the way, could handle the entire load of the financial system right now. Clearly it couldn't. But for the size of the ecosystem it's actually able to handle it. The size of the ecosystem the financial system is supposed to be handled, it can't. And that's just true. And there's no getting around that. And this is the second crisis that's illustrating it. So it's time to move on. We got to figure out something new. And I think clearly Bitcoin is showing that as an example of what it can be. And so I think this is really highlighting Bitcoin. Now, obviously, Bitcoin and gold are fluctuating all over the place, just like the stock markets. So that's why I kind of think be safe, have upside potential in Bitcoin and potentially gold. But ultimately, let's preserve capital. These are dangerous times. I don't need to try and make a lot of money whipping around in the markets. Build Paxos and create long-term value. And so that's how I'm focusing on things. If you could unwind me and put me back in a trading seat, I mean, this would be something that would really be both a lot of fun and a huge amount of stress on. But that's not what I can do now. I can't do that well and run all these other things that need to be handled. So you got to kind of pick what you can do and then do that well.
First of all, I agree with you 100%. I have one comment just to follow up on that with some data, and then one lightning round two-part question, and then we'll wrap up. But the thing that people don't understand, when Bitcoin was born, it was in the teeth of the financial crisis, and that's when we started racking up deficits, and you had TARP, and you had all of this, QE infinity easing. The one stat that stands out to me is we pre-financial crisis were about 65% debt to GDP. That swelled all the way up to swelled. I don't know.
Swelled, I think,
all the way
yes.
all the way up to 105%. And it only then started to tick a little bit down with the Fed unwinding its balance sheet, with us narrowing the deficit, and now it's back up. Now over 105%, and now we're talking about, it is hard to envision a scenario where we don't get to 150% plus debt to GDP, which is an enormous.
And when you say debt,
load.
you mean then that's the government debt, because
Yes.
total debt to GDP is 330%, all-time
Yes.
highs around the world, which
Just
is the
talking about
crazy
currencies.
thing.
Yeah, and a lot of that's
Yeah,
dollar denominated, so
yeah.
things are going to get weird, and I don't think we're out of the jungle yet.
I agree with that.
So, I think, which is to say, there's some real numbers backing this up, not just intuition. Final question, though, we'll end with a fun one, and I'm glad that we had the conversation early on about the financial crisis and kind of the Big Short-esque type of start that you had, because it is going to yield my favorite question for all future guests. My first of the two-part question: which character would you have been in The Big Short?
Oh,
Or which were you?
Believe it or not, Cedar Hill's mentioned in the book on one of the pages. I actually was very happy to not be in the book. So I guess none of the characters.
Okay.
Can I pick none of them?
All right, I'll let you off the hook for that one, only because I'm going to ask the second one. When the story of this industry is written, you're not going to have an option like you did with The Big Short not to be in the book. You are definitively going to be in the book. If you are in the book and the movie, who's playing your character, or who would you want to play your character?
I have no idea. Jason Biggs.
Nice. All right. I'm hoping I'm going to ask this question enough where there's collisions, and then we can have a battle royale for.
Yeah, I know that'll be fun. Someone else is going to try and take him, and we're going to have to go after it.
Throw it out. Oh, and well, we didn't even have a chance to talk about kickboxing, so we're gonna have to have you on again to regale us with some of your tales from the ring or the octagon. But we'll save that for something next.
No, that's right. We always want to leave the audience wanting more. So it's good spending time with you, Ryan. Thanks a lot.
Yeah, likewise. And Chad, always a pleasure. Good finally catching up again. Stay safe, be good, and for everybody that's watching, take care, and thank you for tuning in. See you next time for Unqualified Opinions. Peace.